Do you have a fancy car? If you do, ask yourself, did you really buy it because of you, or did you buy it because you want to impress others? Here's the uncomfortable math behind that decision. Cars are not just a payment, they are a stack of costs. Depreciation, financing, insurance, maintenance, taxes, and fees that quietly kneecap your ability to build wealth. AA's latest Your Driving Costs study pegs the average cost to own and operate a new vehicle at roughly $12,182 per year, about $1,000 a month, before you've even tried to flex. That's the average car, not the status one. Now zoom in on the payment culture. New car payments have drifted into mortgage-adjacent territory. Experience Current Red shows about $745 per month on average for new cars, with a growing chunk of shoppers committing to over $1,000 a month. Loan terms commonly stretch 67 to 84 months to make the numbers look affordable. Translation: you're renting a fast depreciating asset for 6 to 7 years and paying steep interest to do it. If you're leasing beyond your means, the hole is deeper. Imagine the Porsche payment life: $1,200 a month for the lease, $220 for insurance, $120 for maintenance, tires spread over the year, $80 registration, and miscellaneous fees. Call it roughly $1,620 per month before fuel and parking. That's over $19,000 per year, leaving your account to impress people who won't pay your bills. Kelley Blue Book's pricing backdrop hasn't helped either. U.S. new vehicle transaction prices hover around $48,000 to $50,000, so even normal cars now carry luxury-level outflows. There's also risk in the background. Auto delinquencies have been rising as households strain under bigger payments. The New York Fed reports an elevated share of auto balances rolling into late status compared with recent years. If money gets tight, the car note and the insurance bill don't care how good your Instagram looks. Yeah, but everyone treats you better when you roll up in something nice. Exactly. And that's the trap. Social credit often flows to the driver with the flashiest badge, even if the badge is financed to the hilt. The problem isn't wanting a nice car, it's buying or leasing one before your finances can carry it without flinching. The wealth damage isn't just the payment, it's the opportunity cost. $1,000 a month shoved into a broad market index for a decade can snowball into serious money. $1,000 a month into a car melts on your driveway. The difference is your future. Here's a clean sanity check for the video, and it's deliberately strict. First, the car's price should be at most 3 months of your gross salary. If you make $5,000 a month, the maximum car price is $15,000. Second, you should be able to point to cash or near cash equal to at least 3 times the full price. Not a loan approval, not a hoped-for bonus, actual liquid money. If the car costs $15,000, you should have $45,000 accessible. That cushion says, I can buy this and still breathe. If those 2 sentences feel impossible, that's the point. The car you want today is probably outrunning the life you can comfortably afford. Let's run 2 quick, realistic examples you can narrate on screen. Scenario A is the flex lease, $1,200 a month for 36 months, plus the running costs we mentioned. You'll burn through roughly $60,000 in 3 years, and at the end, you own nothing. Scenario B is the boring buyer. You purchase a reliable $15,000 car in cash, drive it 5 years, budget $1,500 a year for insurance and upkeep, and set a separate automatic transfer of $1,200 a month into an investment account. In the same 3 years, the lease burns $60,000. The boring buyer has put about $43,200 to work, plus avoided the payment stress that shows up in the New York Fed delinquency charts. Even if markets wobble, 5 more years of the same habit puts you financially miles ahead of the flex. If you want a why it feels so hard aside, the industry optimizes everything to make unaffordable feel affordable. Longer terms, lower monthly, bigger cars. Edmunds shows 60 to 75-month loans as the norm now. Insurance inflation has been brutal. Repair and maintenance costs have also jumped. The all-in cost curve is up and to the right, even as the sales pitch says, it's only a few hundred more a month. So when does a fancy car make sense? Honestly, it doesn't make sense in a spreadsheet at all. It's a luxury. Luxuries are fine when they're purchased like luxuries. After investments, after emergency buffers, after debt is tame, and only when the total outlay barely dents your cash flow. If buying the car doesn't change your savings rate, your sleep, or your options, enjoy. If it changes any of those, it's not a car. It's a wealth siphon with leather seats. Close your script by pulling the ego out of the driver's seat. If the car passes the 2 sanity checks, at most 3 months salary price, at least 3 times the price in liquid assets, and your monthly savings rate stays intact, you're choosing a toy, not a tumor. If not, let other people collect the compliments while you collect assets. A quiet bank account beats a loud exhaust every single time. Please like and subscribe.